Level 1, the beginner. You open the account with $500, money you can't really afford to lose. That's the point. Small enough not to matter, big enough to feel real. First trade, a meme stock up 40% pre-market. You buy the green candle. Green feels safe. 4 minutes later, you sell the red one. Red feels like the building's on fire. You do this 6 more times before lunch. You learn nothing. Just the shape of panic in your own hands. Week 1. Down $180. You buy a $297 course. Proven 3-candle reversal system. 11 slides you could have found in a library book. You revenge trade. Double the size, try to make it back faster. You lose that too. 90% of retail day traders lose money in their first year. You are, statistically, unremarkably normal. You start watching finance TikTok at 2 a.m., screenshotting setups from accounts with laminated Lamborghini backgrounds and 4,000 followers. You notice the app pings your phone with movers alerts, time to catch your attention loosest, mid-meal, mid-commute, and you don't yet understand that the interface was never neutral. It was built to keep your thumb hovering over the buy button a half second longer than is good for you. By week 6, your $500 is $210. There's a specific shame in this rank nobody names. The gap between the Wolf of Wall Street fantasy and the actual repetitive math of losing $12 7 times because you confuse conviction with information. Most people quit here, not because the market is unbeatable, but because losing money while feeling stupid is one of the least tolerable feelings there is. You don't quit, you just open the app again and say, one more day, you add $300 you told yourself you wouldn't add, just to average the account back to even, and it bleeds the same slow way the first $500 did. Small, defensible sounding decisions stacked end to end. Your broker sends a year-end document showing 41 wash sales you don't understand yet. You didn't know the IRS had opinions about how you lose money. Level 2, the student. Month 3, the shift happens quietly. You stop chasing candles and start reading the tape, volume, VWAP, float, the difference between a 2 million share float and a 200 million one. You backtest, unglamorously, 340 rows in a spreadsheet and find a real pattern. Gap and Go stocks with relative volume above 5x hold their pre-market high through the first 5 minutes 61% of the time. Not a law. An edge, you're still losing money, just slower, with more dignity. $34 on a trade you can explain instead of $80 on one you can't. You find you're a completely different trader with paper trading money. Patient, disciplined. The second real money enters, your hands shake again. The market was never the hard part. Your nervous system was. You discover paper trading and feel embarrassed it took this long. You run a simulated account for 6 weeks and find you're calm, patient, disciplined, right up until real money enters the equation again. You start following traders whose track records you can actually verify, and notice the good ones post their losses dissected more than their wins. You do the same in your own journal now, not just what happened, but why you clicked. By month 5, you understand, intellectually, the goal isn't to be right, it's to win more on wins than you lose on losses. Simple math. You still cut winners early out of fear 17 times this month. You write it down every time. You learn to read a level 2 order book, clumsily, watching size sit on the bid and vanish the instant price approaches it. Not real support. A trap traders have been running on beginners for decades. You take a Saturday off the charts entirely and notice how much of the last 5 months your mood has been tethered, hour to hour, to a number on a screen. You write at the top of a fresh journal page. The account is not you. Level 3, the break-even trader. This is trading's dirty secret. Breaking even is harder than losing, and almost nobody warns you because flatlining for 4 months while fees quietly eat your P&L isn't a story anyone tells. Your win rate sits at 52%. Average win $61, average loss $58. It should be slow progress. It feels like a treadmill bolted to the floor. You start taking every stop loss instead of giving it room. Some weeks that discipline saves you. Other weeks the stock reverses 4 minutes after your stop and rips 9% the direction you called, and there's no way to know in advance which week you're in. You cap every trade at 1% account risk, which feels insulting after 8 months of study, but you keep doing it, because everyone who ever blew up an account did it by ignoring that one variable exactly once. 4 months in, you're up $340 for the year against $4,000 in gross volume moved. Nothing, by any reasonable measure. Everything quietly, because for the first time a losing week has a mechanical reason attached to it instead of a mystery. You start tracking expectancy per trade, on 40 barely positive, almost embarrassing, and you learn that a small positive number compounded across thousands of trades is the entire foundation professional trading is built on. There is no other foundation. You have a week where you go 2 for 11 and the account is still up, because the 2 wins were each 3 times the size of any single loss. The first time ratio has done more work than win rate. It rewires how you see a loss, not a failure of the setup, but a scheduled cost of doing business, the premium you pay to be present for the trades that pay for everything else. Level 4, the profitable trader. The turn doesn't announce itself. Month 11, you close a week up $890, check back, and realize you've been net positive for 4 straight months. You wait for a 5th to confirm it isn't a fluke. It isn't. Your edge has a name now. Morning gap and go setups on small caps with relative volume above 5x. Entry only after the 5-minute candle confirms, hard stop at that candle's low. Boring, repeatable. It wins 44% of the time, and the wins run 2.3 times the size of the losses. The arithmetic works, the entire definition of an edge. You stop watching CNBC and mute your group chats during market hours. Other people's excitement about a ticker is information about them, not the stock. Your account crosses $12,000, built from the original $500 plus deposits you made once you trusted the system enough to fund it seriously. You apply for a $50,000 prop firm evaluation, $297 entry fee, 8% profit target, 5% max drawdown, fail the first attempt on a tired, distracted Tuesday you shouldn't have traded, and pass the second. Same lesson in a new costume. The market didn't beat you. You beat you. You finally read your own tax situation seriously. Short-term gains taxed as ordinary income, trader tax status if volume justifies it, the reality that a chunk of every green month belongs to the government before it belongs to you. You upgrade your tools now that the account justifies the cost instead of before. A real scanner, a faster data feed, and notice they don't move your win rate at all. What they move is your confidence in your own process, which turns out to be measurable, because hesitation at the entry is where most of your remaining losses still live. Level 5, the funded trader. Now you're trading a firm's $50,000, capped at a $2,500 daily loss and $2,500 max drawdown, and somehow trading someone else's capital under a hard rule set is calmer than trading your own ever was. Your first payout, $1,840. Feels different from any dollar you've made before. You tell almost no one. You start scaling, not bigger single trades, but more funded accounts, more capital running the same disciplined edge simultaneously, 3 accounts now, $150,000 in aggregate buying power that isn't yours but trades exactly as if it were. Your routine gets boring on purpose, bed by 10:30, up at 5:15, trading window 9:30 to 11, done by lunch. A drawdown month arrives, $3, 100 across 3 weeks. The old you would have revenge traded through it. This you cut size in half and weights, 11 months of profitability, roughly $38,000 in cumulative losses paid across the earlier ranks, and you finally say the word out loud to your family. Trader, not trying. Trader. You get your first payout dispute, a firm flags a trade for gap trading, a scheduled news event technically inside their rulebook's gray zone, and $200 in earned profit sits frozen for 2 anxious weeks before it resolves in your favor. You start mentoring. Informally, someone in the Discord asks for a call expecting to talk entries, and you spend 40 minutes on position sizing and taking a loss without making it mean something about your intelligence. You realize, mid-sentence, you've become the trader you spent a year looking for and never quite found. Level 6, the fund manager. Someone asks you to manage real money directly. $80,000 from a friend of a friend who watched your track record for 6 months. This is a different weight entirely. You register properly, draft a real risk disclosure, explain drawdown probability in plain language before the first trade. Assets under management grow, 9 accounts, over $600,000, a part-time analyst you hire straight out of the same Discord where people once asked you how you did it. You spend less time hunting entries and more on portfolio level risk, correlation, aggregate exposure. A real drawdown hits, 11% across 6 weeks, and 2 investors pull out. It stings in a way personal losses stopped stinging years ago. You hold your risk rules anyway. The 7 investors who stay watch you recover it methodically over 4 months, and their trust afterward is worth more than the recovered capital. You've become the adult in the room other people's futures quietly depend on. You hire a compliance consultant part-time. Filings, state-level rules, disclosures you didn't know existed until you'd quietly been out of compliance on one for 4 months. Unglamorous, and at this scale, exactly as important as the trading. You turn away capital for the first time, $200,000 from a prospective investor, because your strategy has a capacity limit, past which your own entries start moving the market against you. Saying no to money is a rank nobody warns you about. It's also the clearest sign yet that you understand exactly where your competence ends. Level 7, the market legend. A decade in, you manage capital in the 8 figures, with a real compliance department and 17 straight quarters where you told your investors the truth, including the 2 quarters that truth was ugly. Your calls move markets in small, specific ways. You've learned to be careful with that, because influence at this scale can move the exact price you're trying to analyze objectively. Younger traders reach out constantly. The same desperation you once had at $210 out of $500, wanting a secret, a shortcut around 11 months of losing money on purpose. You give them the same 3 unglamorous sentences nobody wants to hear, the same ones nobody wanted to hear from you. You still keep a version of that first spreadsheet. You still take your stops. The numbers have 4 more zeros. The rules haven't changed at all. Journalists call occasionally for a quote on a volatile day, and you've learned to say less than you know, because a legend's offhand sentence, printed under a headline, carries weight it was never meant to carry. You give careful, boring answers on the record now. The boring answer is a skill too. You think sometimes about the version of you with $500 and a course that promised a shortcut, losing 47 times in a row and telling no one. You don't think about him with contempt. He had no idea what the actual war was going to be about, and he was right to keep showing up anyway, one more day at a time, long after most people around him had quit. So, where are you on this path right now? Beginner, still bleeding and not sure why. Break even, grinding in the least glamorous rank of all. Funded, finally trading someone else's capital and feeling the rules click into place. Tell me your rank in the comments, and tell me the one lesson it took you the longest to actually learn.